Candlesticks. It's one of the most important and fundamental concepts of trading. If you master the candlesticks, I guarantee you will become a professional trader soon. Anyone new looking at candlestick charts, they feel overwhelmed. I get it, don't worry, you're not alone. It can feel overwhelming at first, but here's the exciting part. Those candlesticks hold powerful clues about market trends and trading opportunities. Stick with me and I'll break it down for you. By end of this video, those confusing charts will make perfect sense and you'll be ready to use them like a pro. Before we dive into this, let's ask, why would you want to learn about candlestick charts? We often rely on line charts as you see here, but here's the catch. While they are useful, they have a limitation. They show you whether a stock is going up or down, but they don't give you enough insight into its momentum. You cannot tell if an upward trend will continue or if downward trend will reverse or keep falling. That's where the challenge lies. We are diving into the basics of candlestick charts, one of the most powerful tools in technical analysis. Whether you are a complete beginner or just looking to refine your skills, understanding candlesticks can transform the way you view the markets. Trust me, it's not as complicated as it looks. Let's start simple. A candlestick represents price movement for a specific time frame. This could be a minute, an hour, a day, or even a month. Candlestick itself has three parts: body, the down wick, and upper wick. What do they represent? The lower part of the body, called open, represents where the price started for the time period. And the upper part of the body represents where the price ended for the time period. But during this time period, the price can fluctuate a lot. So that's what the wicks actually represents. The lower wick represents the lowest price during the time frame, and the top wick represents the highest price for the time period. For the red candle, everything looks about the same except the open and close positions are reversed. The price opened higher and it continued going down and it closed at the lower price at the bottom of the body. Everything else remains the same for this. So I'll show you an example of how this moves up and down. So if you see the green candle, it started at some point and it moved up. So the price was $9, it moved up $13 plus 4. So it opened at 9, ended at 13. So it increased, so you get a green candle. So for example, the price started at $13, but it moved down and ended at $9, which is $4 down from $13, which represents a red candle. So basically, if the price ends higher than the open, then you get a green candle. If the price ends lower than it opened, then you'll get a red candle. It's very simple like that. So what do they really convey, right? So you get a green candle, red candle. How does it really matter? What do they convey, right? So it shows you who's in control, buyer or sellers. If more sellers are in the market, the price gets pushed down and you will get a red candle. If the if the buyers are in control, the price moves up and you get a green candle. So this could really help you spot reversal points or continuation trends in any given chart. So, and also this is a visual way to anticipate potential moves in a given chart. So basically there are three patterns you want to start off learning about it, and there are a lot more patterns to come, but this would be the basic ones which I want you to start learning about. The hammer pattern, an engulfing pattern, and doji candle. So I'm going to break it down for you in the next. The hammer pattern, as you see here, it looks like a little hammer, right? So there are no upper wicks, it's only the lower wicks. What does it really mean? The sellers are trying to push the price down, but they could not do it because there are more buyers than sellers, and the price got pushed up and it ended higher than the open price. So that means the buyers are in control, so there's a potential bullish movement is going to continue. The next one I want to talk about is engulfing patterns. So as the name suggests, One engulfs the other one. For example, if the green candle, you get a small green candle and then you get a big engulfing red candle, that means the sellers are taking over control and the prices are going to drop and the trend is going to move downwards. At the same time, this is called bearish engulf. The next one is a bullish engulf, which means you get a red candle, smaller red candle, and then it is engulfed by a larger green candle. This means the buyers are taking over control and you're going to see upward momentum in the price. The next one I'm going to talk about is the doji candle or doji pattern. Doji pattern is basically you see a candle which has a smaller body, which almost the price started and ended almost at the closer range, and you have a big price momentum with this down or upper wicks. That means neither buyer or seller are in control. This is called indecision. That means they both trying to take over, but none of them had got it yet. It forms when the opening and closing price of an asset are very close or exactly the same, creating a small or non-existent body in the candlestick. The doji represents a tug-of-war between buyers and sellers, as I mentioned, indicating potential market reversal, continuation, or consolidation, depending on its context in the trend. Awesome, great work so far. These are just the basics, but even these patterns can make a huge difference in how you approach the market. Start practicing by spotting these on charts and see what the market is telling you. And remember, every candlestick is a piece of the puzzle. Thanks for watching my channel. If you found this helpful, smash the like button, subscribe for more trading insights, and drop a comment below on what patterns you would like to learn next. Until then, happy trading.